Splashcreen. Wake up, motherfucker.
What's up? What's up? What's up? Okay, July 18th. Yeah, sorry. I wanted to do two streams today, but I guess you only get one. I was up all night with Schizo on his panel. So, Schizo Spud. So he's gonna do another panel right pretty soon. So I'm just gonna knock this one out. We're gonna talk about solar cycles. Okay, so we're gonna look at that. Let's see. First, first up, let's get this going and hold up. Okay, get this going. All right. Do some. Which one do I want to do first? Let's look at some tweets here. All right, let's just do the tweets first. So I tweeted this out about the yen and the dollar. I don't know how much time I want to cover this. I might go in depth on it. Let me see. Let's zoom in. Here, okay. Got a hedge fund shorting the yen. Okay, this one looks like we're the most bearish it's been since 2007. Oh, all right. And let's look at what the Japanese are doing. The Japanese retail traders are shorting the dollar. All right, so Japanese retail investors are increasingly betting against the US dollar. Net dollar short positions held by Japanese retail traders are up to $17.2 billion, the highest since records began in 2008. This figure has more than quadrupled from month over month. The surge reflects growing expectations that Japanese authorities will continue supporting the yen through intervention, encouraging retail traders to position for a weaker US dollar. This comes after the Ministry of Japan spent $73.6 billion to support the yen between April 28th to May 27th, with the yen still falling more than 4% from its May high. Retail investors in Japan believe the US dollar rally is nearing its end. Okay, we got one more here. Let's see. The cost of hedging against swings in the US dollar has fallen to its lowest level this year. Implied dollar volatility sinks to a year to date low. Conviction is low as a patient Fed. Geopolitics offer mixed signals. So it's pretty quiet with the dollar. People are. But their positioning seems to suggest we're going to have a big move up or down from here. Now, I don't know who's going to win, right? Is it the Japanese or the hedge funds? Huh. Okay, so I think all I'm gonna do is talk about the cycles we see on the yen. I think that and the dollar. How about that? That's all I'm gonna say about it. Because I don't have any insights on currency markets. You might, maybe Samantha Leduc has something to say, but I'm not sure if she said anything on her free uploaded videos on YouTube. So I'll have to see if she said anything. But we're near a tipping point for sure. I just don't know when it's going to happen, right? This could just be a condition for something that will happen at the end of the year. I think Samantha was saying something would happen at the end, towards the end of the year. That was what she expected some months ago, but she might have changed that prediction. So we'll have to see. That's going to affect everything else. Obviously, you know that the yen is an important currency in world matters because it affects the liquidity of global markets. So let's do some analysis here. So I got my USD to Japanese yen currency pair. All right, so let's see what the cycles have been like. So let's go back a bit, see what cycles were important during this moment. Okay, let's go. All right, so looks like we got 136 over here and 90 over there. So I guess the 90 might be more important, huh? Okay, let's see. Let's see. I'm just doing it with you guys on the fly. Okay, let's see then. So let's see how good this cycle has been at predicting things. All right, I'll go with this cycle. 136. That looks pretty good. But it has a low score. How about the 90? That looks a bit better. Okay, it has a higher score too. All right. Let's go with the 90 for now. Okay, the 90-day cycle. All right. So it looks like we could be at a top here, maybe. July. Okay, so the end of July, and then it should weaken. Whether that means like it's just going to crash all the way into September, that's what this suggests. Or we just go, we just weaken, or we just go sideways. Doesn't matter. We'll have to wait for the next cycle to hit around November. Maybe this is where things really happen towards the end of the year. It's not going to happen now. But okay, we'll have to pay attention, right? When's the next BOJ meeting? I don't know. Oh boy, I'm gonna have to see. Oh, we're gonna have to see. What is the next BOJ meeting? Next BOJ meeting. July 30th. Oh crap. Okay. That really that really syncs up with this cycle, doesn't it? Oh man. Okay. All right, let's see. 90 and 136 might be the cycles that I care about. All right. Keep that in mind. We'll just let me add the cycle over here. Take this away, put it over here. All right, we'll shift the data a bit and see what the cycles say. Once we change this, what we got? 148. And we have a 74. Okay, so we have similar cycles. Remember, it was 90 and 130 something before. Now it's 148 and 74. All right. Okay, kind of similar. Okay, we're going to go down. That's what it says here. Okay. 148. Okay. All right. Nothing much changed. So let's look at the smaller one. Maybe we'll have a problem in January or September now. So, yeah, it's shifted, right? We're shifted. We changed the frequency a little bit. So we'll have to see. We'll have to see if this pans out. All right. That's what we got. Okay, gotcha. All right, let's look at the dollar. Let's look at the dollar. See how that goes. Dollar here. See if they got similar cycles. 179. All right. This one's dominant. And then after that, we got a 90 over here and a 72. Okay. Okay. Let's see what the 72 gives me. 72 gives me. Dollar is going to weaken into August. Okay. Okay. Similar. That's similar to what we just saw with the dollar yen. So this is a dollar index. Dollar index is a basket comparison. So it compares the dollar with like a bunch of other currencies, mainly the euro. So yeah, the dollar index, you might as well think of it as dollar euro. Yeah, because that's the most dominant one. After that, like you got a mixture of yen, British pound, Swiss francs, Canadian dollar. Somebody else, I forgot. I don't think there's a Chinese yuan comparison. No, I don't think so. Somebody else after Canada. Yeah, I don't remember now. All right. Then there's this large one. I don't think this is going to be an important cycle. Yeah, I'm just gonna ignore that one. This 180 is similar to the other one that we saw. This one goes down into October. So yeah, so both of these cycles say the dollar is gonna weaken. Okay, it's gonna weaken against somebody. Whether or not it's gonna weaken against the yen at the same rate as the euro, or is the euro gonna dominate the thing? I don't know. But the other reason I would bring this up, whether or not this crashes the stock markets of the world, is that it also affects gold. So we have to see if gold is going to be at a bottom, right? So yesterday I kind of alluded to the silver. I see something with the silver because retail investors in silver have ran out. They pretty much are bearish. Same thing with like Bitcoin, right? They all been chasing semiconductors. So if the semiconductors is going to end in a week or 2 or 3 weeks, like that whole trade is over. There's nobody's going to come back to semiconductors anymore, and semiconductors is going to continue to go down. Where's that money going to go? Well, a lot of money was taken out of gold and silver at the beginning of the year, right? And that money kind of was floating, going into oil stocks for a little while. Perhaps they were chasing the Iran war stuff. Maybe they were using that money to get into biotechs. Who knows? They were running into somewhere else before April. And then by the time April came around, right, they just ran back into semiconductors. So they probably used that to increase their leverage in their semiconductor positions. Well, silver's up 57% in a year, and the ETF crowd just fled at the fastest pace since 2014. Here's the part they missed. That metal didn't get sold. It got pulled out of the ETF SLV. So a lot of retail investors, when they want to chase something, right, they probably aren't going to go out and buy physical gold. A lot of them will just chase the ETFs. That's the easier way to buy silver, gold, palladium, platinum from their brokerage accounts. You can't just cash out. You can't just go to a bank and withdraw a bunch of cash and then just go into a silver or gold coin shop and just buy it there, to avoid like the IRS snip. Because that's what you should do. I mean, honestly, if you buy physical, you should just buy in cash, okay? Because then it won't get recorded. Now, you can buy it with your credit card, but it's gonna get reported to the IRS. And I already covered it. If you're holding physical metals for long periods of time and you want that good capital gains tax, you're not getting that. You're going to be charged at a higher rate, okay, a collectibles rate, because it's going to be treated like a baseball card, a Pokemon card, a piece of art, anything that's considered quote unquote a collectible, whatever the IRS deems that is. And so if you're going to use your credit card, you're going to get reported. So if you might as well just buy the ETF, right? You're not going to buy this ETF though. Okay, that's the thing. Don't buy this ETF. Don't buy SLV. SLV will be treated like silver. You should buy the Sprott ETFs. So go back and watch that stream where I talked about that. I forgot which stream it was. I didn't put hashtags on it. I got to go back and figure out which stream it was. I'll put a hashtag and go like, you go over there, you search, and then you go search silver Sprott, and you'll find it. So if you go and look for Sprott on Google, you should be able to find it. Sprott ETF. Here you go. Investment strategies, tax guide. Here you go. Sprott.com, SPROTT. And you got the tax guide. And please, if you use this ETF, they have a whole suite of ETFs for you. Okay. They also have palladium, platinum, uranium. I recommend just buy the ETFs that these guys provide if you want to hold something long term. Okay. Let me see. What's the list of the ETFs they got here? Yeah, you got gold, silver, gold plus silver, palladium, platinum, uranium, copper. Oh, yeah, they got copper now. Very nice. So yeah, there we go. These are the physical ETFs over here. Okay. So if you're buying something that wants to track the actual physical metal, but you don't know how to use futures, you don't want to learn how to use futures markets, and you want a good tax uh, end of position tax like treatment, okay, tax treatment, you must follow these rules. So once you buy it, you have to fill out a form. So unlike other things where you sell it and then you have to do your taxes, this one, when you buy it, you should fill out this form. Even if you're not selling it right soon after, you have to fill this out just in case you want to sell it at a much later date, at least a year or plus. Then you get the tax benefit. Okay, that's very important. So there you go. Tax treatment if held over a year. If you buy these ETFs, it'll be treated just like normal stocks or bonds or anything else that's not part of the futures or options market. Okay, Sprott physical bullion trusts, 15 or 20% tax at capital gains tax rate. Okay, this is for married filers. You should talk to your accountant or tax preparer. You might be able to get to 0% if you have very low income. So if you're on welfare, if you make no income, if you sell something after a year, you probably can get 0% taxation. Otherwise, you get this treatment. Boom! You get taxed at 28%. Ooh, that's a big difference from 15 and 20 and potentially 0. So please, please, please fill out your QEF forms, all this stuff, if you start doing it. Okay, that's an aside right there. Anyway, done with that. Okay, so Sprott ETFs. Anyhow, most people, they probably don't even know that. They just trade with SLV because they don't know any better, right? This is the first silver or gold ETF is a GLD. These are the first ETFs they see when they type it in the little search bar, right? So here you go. Silver ETF capital flows. They ran the hell out of there really fast. So this probably means they're very bearish. Very bearish. We're probably close to the bottom, if not the bottom at this point. So I want to look at the silver cycles. Okay, that's what we're going to look for. So let's see if this thing lines up with this dollar index right here. First, I want to look at the weekly. So this is not the daily. I want to see the weekly. So I want to see which cycles were dominant. This is also the reason, like, I was recommending silver to people back in 2023. Okay, before, and I did a little bit on John Galt's show, like in 2024. I kind of did say, like, yeah, you should buy silver and gold, but at that point, you know, I was kind of wondering if it was the right time to get in or not, because 2023 was the best time. I think that was the time I was feeling that it was about to move into 2024, because for gold, it definitely moved. Gold definitely moved. Silver, it wasn't, right? Silver took another year after that to finally start moving, but gold was already on the move. So it was hard for me to recommend 2024 at that time, because I didn't know how high it was going to go in a year or two. It might have kept going sideways. So that would suck. You're better off buying semiconductors or something else at that time, or software. Okay, so let's see what we got here. We have one cycle, 250, about 250 weeks. And you can see, like, this was not good, right? This was not a good predictor, because it says, like, the top was around 2025. Okay, well, this is not the right cycle to use at this point, because there was some other cycle that was coming up here, 177. So you see, like, there are these two cycles, either 250 or 177. That's rank 1 and rank 2. Okay, so let's see what the rank number 2 one says. Okay, this is a bit better, right? Because it's kind of predicting what was going to happen in 2025 into 2026, kind of. But even that didn't seem like it was going to be the right one. So we have to see. This is the problem with, like, silver and gold. these cycles shift a lot compared to the some other things like the stock market. This one's better. This 104. This one isn't picked in a ranking though by the AI here. This is like AI picking it. But I see a 104, and the 104 is down here. So there are some cycles here that look like they want to be important. The other one is 88. Let's see. This one's ranked 4. Nope, this one ain't gonna cut it either. This one ain't gonna cut it either. So this 104 looks promising. Looks promising. So let's see if this 104 becomes dominant right now with the current data. So let's go up here. Okay, so I'm going to take away some of this data over here and go back to 2014. So I'm going to do log scale so you can see like it better. So let's see what it is. No, that takes away too little data. Let's go this way. All right. So this 104 that we saw before becomes 114. Okay. And then we have another one. This one becomes dominant, this 176. So let's go back and see if this newly dominant cycle, what does this point out? It says we're going to go down into March or January to March. So first quarter, maybe the tail end of the year into December. That'll be the best optimal time to look for a bottom. That's all it says. It doesn't mean it's going to go down into these months. All right. We could be over. Like we could be done. Like the closer we get to about here into August, this might be the bottom, right? We're almost in August. So I'm looking for a bottom right now. But the cycle says like, well, it could still like just go sideways into the first quarter of next year before it goes up. All right, let's look at the other cycle. 176. So this one says about November. Okay. November of 2027. So into next year. So this one is going to take a while. So let's see if that's going to be true. So we got two choices. Either we're going to be done fairly shortly in a few months, or it's going to take another year. That sucks. And yeah, gold and silver, those type of things, they don't necessarily have to act quickly for you. A lot of people, they wait on these things for a long time. We've seen it last for 5-10 years, right? These gold bulls, these guys are bullish on gold, and they've been waiting for so long that they could have been putting that money somewhere else at the same time. So you're doing opportunity cost. 1 year is a long time. A long time. If it's just a few months, sure, I'll reopen a bunch of silver and gold positions, and wait into next year. But if it's not going to happen for a whole year more, then I don't think I want to do that. Okay, let's see what this one is. This 360. Oh, this thing wants to go into 2030. This might be the true cycle, right? This one might be like, oh, this is the big one. This is like some super cycle that says like, yeah, there's going to be something happening into 2030, 2031. And this kind of goes into our solar discussion later on, if I could just get through all this stuff here very quickly. Okay, so let's look at the daily. We see like maybe the first quarter of next year is where we want to look to buy. All right, let's plan it out. Let's see what the daily cycle gives me. What does the daily cycles give me? I see this dominant cycle already. It's 80. This looks very strong. This short-term cycle says we're at a local bottom right now. So silver could try to bounce fairly shortly in a few weeks, right? If this thing, looking at this RSI, it's been very weak. Okay? Very weak so far these 6 months of the year. And we're already halfway through it. So is it time to escape the doldrums? Well, we already know the weekly chart. The weekly cycle says you could probably wait until a few more months. That's really, you're not in a rush, I think. So let's see what we get here. Yeah, we still see a 78. It's still number one, ranked number one. We see this long-term cycle, though. This one says we're going to bottom out sometime in September to October. All right. Okay, I see that. All right. Okay. And let's just do this one. Okay. Yeah. It shifted a little bit, but pretty much the same what we saw before. All right, nothing. Don't need to worry about that. Okay, let me see. 369. So let's go back and put in all that data we saw at the beginning to the end. Okay. Let's see what we get there. 606. Yeah, this cycle disappears. It's just really not. It's really not something that's prominent right now. Yeah, it's still not prominent. Whatever this 300 whatever thing is, it's like it's still there, but it's just not dominant. October, December of this year. Okay. Well, yeah, so let's see. November this year. Okay. All right. Yeah. So I'm probably going to wait till then. I don't think there's going to be a rush, but I'll keep an eye on it. Because I'm going to show you this. Reversal in semis could see flows back to gold, Bitcoin. Okay. So it might come earlier than expected if we're done. If the earnings are not good, that money will have to go somewhere. And I'm thinking, silver might be looking attractive. Gold might be looking attractive again. Okay. So that's what I'm watching for. Okay, you guys got I mean, it seems to line up. It seems to line up. If we got the weekly here. So again, let's go look at the 114. This is the cycle. So towards the end of this year, right? And we have the daily. And it's showing. Okay, let me put some more data here. Okay, this one could be a bottom right now, but then there could be another bottom coming in October. Okay, it could be that, or it could be another one coming in February. It could be that, right? But this October one, if it lines up with this 114 cycle, okay, October one, this would be over here going into January. So we could be coming in pretty close into October. Not too far. And then we also have this 355. It says around August, September, October. Okay, and also let's get these three cycles together. If we put all these three cycles together with this 200, so let me take away the 200. Let's look at the first two. Yeah, this thing would be like October would be the best. But if this 200 cycle actually is meaningful, then the bottom could be coming up right now. Right? This could be the more significant bottom. I don't know. Okay. Yeah. So I'll pay attention now. From now on, I'm paying attention to the gold and silver again. Okay. If we make a real bottom here, then that's it. I'm ready to go. Otherwise, yeah, you can wait for October. maybe we can go down to a next level low. All right, time to look at Bitcoin. It's time to look at Bitcoin. Bitcoin, what we got here? Bitcoin, and I'm gonna look at gold miner. Gold miner cycles. All right, gold and silver miner cycles. So Versal and semis could see flows back to gold and Bitcoin. This is what it's assuming, because we have here cumulative flows in 2006 going into semiconductors from April going up into July. We see the difference here with the gold and Bitcoin. We see outflows coming out, 17.5 billions coming out at this point here, and then 17.5 billion. I guess this is cumulative. Is this cumulative? Yeah, cumulative. Okay, good. Okay, it says cumulative. All right. So it seems equally matched. So I guess you can make that assumption that money coming out of Bitcoin and gold is going into semiconductors. All right, let's look at the current Bitcoin daily cycle here. This one has been shifting a lot. I played around with this, and yeah, it's like, oh, dude, we could have started pumping into June, but look at that. It's just like it crapped out halfway through it, right? We could have been like continuing on, but then we just crapped out. So I could just take this and go like this thing here. All right. Yeah, we should have been going up until June, but it already crapped out early, just before that, the supposed peak. And that kind of has me worried that Bitcoin, the next movement down, could be very vicious. If I look at the chart on Bitcoin, it looks like it's improving. It definitely looks like it's improving. So I gotta be tentatively bullish, but the cycle right now is turning. It's going to turn bearish, or already has turned bearish going into October. So if we do make a pump, it might be very short-lived. Okay, it might only last like a little bit into August, and then by the time we get into late August, early September, it should viciously pull back down into November. That could be what we're seeing very shortly. That could be the one. That could be the big dip that would scare people. That would think like, oh, it's over. It's over. Oh my God, and that would be the time to buy. Usually Bitcoin does that. Bitcoin doesn't do anything easy. Like they make sharp tops like this one up here back in October, and I'm sure they'll make a nice little V bottom sometime soon into September, and that's where I'll begin. But if you just want to just wait it out, I've just told people, if you're really still a long term into crypto and you want to get in, the best time would more likely be closer to the end of the year, right? When we have tax, when we have to have people that deal with taxation, they're gonna be like, oh man, I gotta take the tax losses. December, getting closer to December, November, December will be the best time to get in. Okay, let's see what the other cycles. This 60-day cycle. And how important is this one? I don't know. Probably not that important. I think this 260 is going to be the one that really matters. So, see you in November. Yeah, that's what it's saying. That's basically what it's saying. Short term, though, yeah, it could still go up for a little while. I see improvement in the chart. Yeah. Okay, let's look at the gold and silver miner index. Okay, let's see what this one says. Okay. Okay, it's 358 cycle. Yes, you see this one? This one's coming up pretty close to September. This one's saying September would be the time to buy the gold miners. So the gold, I mean the silver one, right, says sometime in October, right? That's what we saw. The silver one, if we're gonna get if we get the worst case cycle here, this 355. Let's take this worst case one. October, yeah. So this one's October. So if I take 3 of these cycles for silver, it says July. That'll be the earliest, but I'm gonna take this one out. So October. But this one with the miners themselves says September. Okay, September. So I think all this stuff is lining up. Everything seems to be lining up to September, October. But there's only 1 month now between us and September, right? August. So we should be pretty close. I think we should be pretty close. So at any given point here, there could be like a sharp drop down. So let's see, maybe 273 on the XAU EAT index. Okay. Yeah, also, yeah, we'll have to watch. We'll have to watch very carefully now with this. All right. So that's all I want to talk about with those things about silver, gold, Bitcoin, because there is some kind of shift happening. Either it's going to be this quarter or the next quarter, right? We're going to have earnings in a few weeks that will determine these things. So if people are running away from semiconductors, they can't stand it, then we have to go back and look at those. So that's what I want to say about that. Let's see, anything else? No. Okay. All right. Yeah, that's it. So I'm gonna read some articles now. I'm gonna have to read some articles. All right, here. And before I do, let's look at these charts. One chart here, and one Bitcoin chart there. Okay, one Bitcoin chart there. Right. So we got this Bitcoin chart. All right. So I've showed you guys this before. The Bitcoin bottom signal per percent supply in profit, 1 standard deviation. So we are now beyond 1 standard deviation of people in profit. 45% of the people right now are making money on Bitcoin in their portfolios. The rest are losing their money. Okay, so all the people that were buying the top back in July, October, they're done. They're done. They pretty much dominate the losers right now. So this is usually a good time to find a bottom. So we could be at a bottom. I mean, we could be, but we might not be, right? So same thing. I think the same thing we should say with people in gold and silver. How much of that is still there? All right. Okay. So that's one thing I want to show you guys. Just to remind you. Here's another thing. Historical path of momentum. Right now, long short momentum factor returns around 3-month rallies of 20%. 11 episodes since 1980. So what this shows is the current momentum trade right now. So yesterday I showed you the ETF momentum ETF, momentum factor ETF, MTUM, I believe it was. And man, there was something else I want to show with that momentum ETF stuff. Oh man, I wonder if it was a tweet. So let me see. Let me see. It wasn't this one. Right, we covered all the silver and gold stuff. That's done. Now, was it this one? Let's see. Man, I wonder if this one. This one's funny, but I don't think I was gonna talk about this. Micron price to earnings growth is now 0. It means the stock is free. I think I just liked it because this guy made a interesting comment here. The denominator is what's doing the work here. Last quarter printed 41.5 billion against 9.3 billion in the same quarter a year earlier. Gross margin 84.6% versus 37.7%, and the current quarter is guided to 50 billion plus or minus 1 billion. Ratios stop meaning much at that slope. That was it for that, but this wasn't the one I was thinking of. Man, I thought I was reading something where was it it was like this Reddit. Let me see if it was this one. It was like somebody tweeted a bunch of Reddit screenshots of people losing a ton of money in their portfolios. And one of them had an interesting thing. They had calls on the MTUM ETF. The ETF I was talking about yesterday. The one that had like a bunch of it's this one. Yep. Okay, I got it. It had Micron, it had Broadcom, all the momentum stocks, right? Johnson, whatever. But here we are. My guess is we're close to a market bottom on semiconductors. A good indicator is if everyone on Reddit blew up their portfolio to $0. So let's see. Okay, I can't verify if this is just somebody just trying to make crap up on Reddit. You know, some people like to do this. They just make up screenshots to post on Reddit just for fun. And let's just look through them. Negative $129,000 lost, down to $40,850. So 75% loss here. Switching to 0 DTE. Yeah, let's keep on gambling our way out of this hole. This one lost $7,294, and they're left with $1,290. A loss of 85%. Here, let's look at another one. Oh, this guy lost 99%. Lost $125,104, down to $990. Like, look at this thing. It's like, what? So before that, he's like, dude, this is not even log scale, so I can't even tell how much profit he was making before this thing went to crap. But he completely changed what he was doing or something. Or he just went crazy greedy and started leveraging. But yeah, it just blew. Oh, this is insane, right? It just blew everything up. How about this one? Oh, $97,500 loss. Only $1.33. 100. I don't even know if this crap is real. You know, but I think somebody replied to something down here. I hope it's still there. But there was like, it showed like the momentum. Let me see. Man, maybe he deleted it. Crap. I thought it was interesting. Dang. I should have took a screenshot. Oh, here it is. I'm bit very at risk management. I'm bit very good. I don't know what the heck bit very good. This guy. From a high of 250,000 in June 1st to closing out at 50K or 15K July 15th. And you see, look at what he's got. He's got It just shows one thing here. So I don't know what his portfolio really is, but this alert down here on the Robinhood, it's like your MTUS. Oh, my bad. So it wasn't MTUM, it's MTUS. But I'm pretty sure we were talking about that yesterday. The MTUS ETF. His calls are expiring on Friday. Okay, so I believe we were talking about MTUS. I think that's really it. I don't think there was an MTUM ETF. Is there? Oh, there is a MTUM ETF. So they should be the same though, right? Dang. Maybe. Well, maybe not. So let me see. What the heck is MTUS then? I guess that's a stock. Crap. Is it a stock? What is this? Metallis. Small cap. Oh well. Yeah. I guess I misread it. I thought it was gonna be MTUM. Oh well. I thought that was like, oh, maybe that's just a sign of the things to come, of people trying to chase momentum, but guess not. Oh well. Oh well. So we don't know. I wish we knew what they had in their portfolio to make it lose this much money. We can only speculate at this point. So that's it. All right. That's all I gotta say for that. Let's read some articles then. Let's read some articles. Let's get through them. Okay, first one up. First one up. First one up. Let's get to the China one. I have to wrap this one up for China. We're going to talk about China. Okay, China's Q2 economic growth cools to 3.5-year low as imbalances worsen. So this was July 14th. China's economy expanded at slowest pace in more than 3 years in the second quarter, missing forecasts, with weak household consumption clouding strong manufacturing and exports and intensifying concerns over the long-term sustainability of its unbalanced growth model. At 4.3%, GDP growth in April to June eased from the first quarter's 5% growth, landing below the lower end of China's 4.5% to 5% full year target. The data adds pressure on Beijing to deliver more stimulus, but many analysts say a closely watched end July meeting of the Communist Party's Politburo, a top decision making body, may not flag major steps due to concerns over ballooning debt. Economists argue the biggest challenge is not the pace of growth, but its composition. Wednesday's data showed retail sales rising 1% in June and industrial output expanding 5.3%, suggesting an overwhelming reliance on global demand for manufactured goods at a time when trading partners are complaining about China's imbalances and the Iran war weighs on the world economy. Jane Hu, who runs a European goods importing business in eastern China, says her income has roughly halved since the beginning of the year as her firm's sales have dropped. An apartment she rents out has been without a tenant for more than 6 months, a reflection of China's huge housing oversupply and prolonged property crisis. Apart from necessary spending on food, I save on everything I can. I haven't bought a single piece of clothing in 6 months. Chinese year-on-year change GDP. Let's see here, quarter-on-quarter, flattening out. Yeah, I mean, short term, I don't know. Is this a trend? Is this going to be starting a trend? Or are we going to have another quarter where it goes down year over year? Still, the economy grew 4.7% in the 6 months of June to June within target, reducing the urgency for major stimulus. Morgan Stanley cut its full year forecast to 4.6% from 4.8%. Ziwei Zhang, chief economist at Pinpoint Asset Management, doubts the Politburo will signal a wider fiscal deficit, given that exports for now remain strong. The government seems reluctant to spend fiscal resources and build up debt. There is a general consensus among policymakers and researchers that China needs to boost domestic demand, but there is no consensus how to do it. A central bank official said monetary conditions were relatively loose at present, but pledged to support domestic demand. Domestically, wages have been sluggish, even declining in some sectors. Industrial overcapacity, U.S. tariffs, and price wars among producers have fueled layoffs in factories, while weak demand and faster AI adoption have slowed white-collar job creation. The property downturn has eroded household wealth and curbed unemployment in construction. Since 2021, the data showed property investment contracting 18% year on year, January to June, while home prices also eased. So there we are here. Okay, new home prices have decreased. Tens of millions of people have fallen out of formal employment into the gig economy, working for ride hailing and delivery platforms for long hours, low pay, and inadequate social security benefits. Investment is slowing. Local governments, which have been a key driver of manufacturing and infrastructure investment, are often blamed for creating excess production capacity and misallocating resources, are now cutting costs, including payroll. Emma Cheng, a 28-year-old nurse in Guilin, a major city in Guangxi, one of China's fiscally weaker provinces, says her income has fallen off a cliff as the local medical sector is underfunded. In the past, I would get gym memberships, beauty salon cards, 10-cent video subscriptions, and replace my phone or iPad. I don't dare spend on such things now. China's fixed asset investment shrank 5.7% year on year in January to June, with even state sector investment dropping 2.3%. Separate data showed new bank loans rising less than expected in June. The primary drag on growth was the investment downturn, said Andy G., an analyst at CtC Markets. A high-tech driven industrial engine running alongside cratering domestic consumption and investment firmly highlights the economy's deeply uneven growth momentum. Growth in China's retail sales and industrial production. So industrial production is fine. Retail sales still looking weak, as we see here. The onus is increasingly on exports to drive growth. Trade data on Tuesday showed external demand is so far compensating for China's internal weakness, with exports beating expectations with a 27% jump, riding the global AI boom. This partly reflected front-loading by U.S. retailers looking to secure inventories for Black Friday and Christmas sales before expected tariff hikes later this year. President Donald Trump's visit to China in May preserved the détente between the world's two largest powers, but their relationship remains fragile. A universal 10% U.S. tariff imposed by Washington in February after the Supreme Court declared some earlier tariffs illegal expires on July 24th, but is widely expected to be replaced with higher levies. U.S. Trade Representative has proposed a 12.5% tariff on imports from China and elsewhere following an investigation into forced labor, which Beijing denies, with a final decision expected in coming months. Moreover, the EU, whose trade deficit with China averaged $1 billion a day last year, plans to bolster protections of its industrial complex from Chinese competition. And renewed conflict between US and Iran is fueling uncertainty over global growth. Larry Hu, Macquarie Group's chief China economist, said Beijing has little incentive to lean off external demand for now. What will cause the current situation to change is when exports fail. When exports slow down in order to still achieve the growth target, the government will do more on the domestic demand. All right, so that is going to be something here. We need the domestic demand in China to go up in the middle class, especially if you want to see the Chinese tech sector. The Chinese tech sector primarily services Chinese people. They don't have a consumer base outside of China. Um, at least as far as I know. I don't know how much it's gonna go into like Africa or Southeast Asia or whatever. Who knows, right? They could be expanding there, but for the most part, these tech companies in China have customers in China. So if they can't afford to buy certain things because they feel like, oh, the economy is getting worse, we gotta save our money instead of spend our money, and the Chinese will run into savings very quickly. They won't spend if they don't have to. Okay, they want to keep their money. They're not like Americans. You could see a Japanification in their economy, which will be bad. So long term for Chinese tech stocks, probably not good. Continuing problems with the U.S., probably not a good idea to buy Chinese stocks that are listed in the U.S. markets anyway. And I doubt you guys are interested in opening brokerage accounts in Hong Kong to buy Chinese stocks that are listed on the Hong Kong Hang Seng exchange. So there you go. You're going to have to read the Michael Burry article and pay him the subscription fee to see what he says. All right. That's it. And I was reading some of that article yesterday. It's behind a paywall, though. Half of that article is behind a paywall. So you'll have to pay to see what he says about that. But I think he probably is bullish on China for some reason. But you have to get around the issues with buying Chinese stocks overseas if you're doing that. Okay, that's it about that. We have to switch gears and talk about the solar. The solar. Boop, 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 boop. Do I want to keep the weekly? Let me keep the weekly. Okay, I'll take away the daily here. I don't think we need that. We don't need that. We don't need this. Okay, this momentum. Okay, I want to get back to this momentum chart here a little while with you guys. So here is the momentum on the dark turquoise, all right, color here. That's our current rally. Most of that is driven by the semiconductor stocks, right? It's also driven by the industrial stocks. So that's one of the reasons why the boomer portfolio had some industrial names on it, like Caterpillar, GE Vernova, Deere, right? Some others I forgot, but you can see right here, most sectors have recently been caught up in the AI momentum trade. Okay, and you can see going to the right is the correlation to the AI stocks. Going upwards, okay, going upwards on the y-axis, more correlated with momentum. So you can see like the XLK Infotech follows mainly the semiconductors, right? They have a lot of semiconductors in there, so it's going to follow that for sure. Of course, they also have some software companies, but those are not helping so far. They probably also have a few of the hyperscalers, not all of them though. Some of the hyperscalers will be down here to the bottom left, the communication services, so that doesn't follow it very well. All right, the other one is industrials and then materials. So those are the three that kind of are doing well. Okay, so remember that industrials like Caterpillar. Now here we are with the long short momentum factor return. So with the turquoise, this is what we're following, and on average when we have a momentum run up that we've had since last year, since last April basically, It makes sense that we're starting to go down now because we have one more month where we might turn around. Okay. And 1 month can come very fast. 2 weeks, we'll have a lot of the earnings already finished. So it could turn around very shortly. In a couple weeks, we could just start going back up. So on average, the black line shows that this is the trend shifting on the third month, moving up here. Now, this peak, the peak that you see on the turquoise, is a lot higher than the peaks on the average episode. So we are beyond the 80th percentile, meaning that we're at the very extreme cases of the momentum rally. So does that mean we could probably go down below this? Could be. Could be. If a lot of people are leveraged and we went up that high, we could also reverse and go below the black line and have a worse than average episode going down. So if the earnings actually turn out to be bad, guess what? We might have to drop a lot in the coming few months before we recover in November. Okay, this could be a very bad quarter for us. So be aware that even though we might turn around, we might have to go a lot lower first before we start turning around. Okay, so I'm going to have to watch these stocks very carefully. Now I'm going to show you the some charts here because we're going to look at some momentum, right? Some like very good momentum tickers. So let me get through them very quickly, and then I could continue reading about the solar flare and whatever stuff we were going to talk about. So let's look at a stock that has nobody wants to buy yoga pants. Okay, so this is a weekly chart. We see here this is not going to be part of the momentum type stocks that we care about. This has no momentum. It actually probably has negative momentum, right? So since 2023, we've been pretty much going on a downtrend for Lululemon. Okay, so this is not the type of stock that we're talking about. We're going to be talking about some other stocks. So let's look at one industrial stock here. Let's look at Caterpillar. So if you remember, Caterpillar is an industrial stock and it does have very good momentum. All right, so let's get back to the log scale. On the weekly chart, since April 2025, we've been going pretty much in a straight line, a nice steady straight line, not a bubble, but very clean. So far last week we went down 7.57%. I don't know why, but we did. Now, is this the end of the momentum? That's what people are going to be wondering, right? Are we at the end of our momentum, or is this going to bounce and continue on up? When was the last time we had this type of action? When was the last time we had this? 3 red bars here. Well, something looks similar down in February. Similar. This was after earnings, though. Earnings pumped it up pretty nicely before giving it all the way back. But then we recovered. The trend was still intact. So is the trend going to stay intact here? Well, we won't have earnings yet, but let's see. Are we going to go back up? That's what you're wondering. Should you buy here? Right? The same thing we're going to look at, another stock, was McKesson. That was the same question that was asked. Now, if you look at the MACD, you see it went down, right? It went down below the signal line. The blue went down below the signal line here for a little while before recovering. And here, once again, we are below the signal line. So are we going to recover? If you look down at the ADX, we're still strong. The green DI is still above the red, but we're at a lower level. The initial one from April, we had a higher range of green DI. But now we're at a lower range. So could we be at the end then? So that's something we have to wonder. All right, another one we have to see is a GE Vernova, another one of my favorites. This one is not a very clean line going up. Okay, from April, it's pretty sloppy. It goes up, went sideways, up a little bit, went sideways again. Then we started moving up before doing this. This is bad, right? And then we had a nice pump here in June, but for the most part, this is a sideways move. So, are we going to continue? Well, if you look at the MACD, here it looks like we're about to crap out. So we're going to have earnings next week. This earnings is pretty important then, right? So let's look at Intel. Intel is the same problem. Look at that one. We started moving up. We went sideways, just like GE Vernova. And at least down here, we could see the MACD is about to fail as well, going below the signal line, right? And it has earnings next week. So these are very important. A lot of these stocks have very good momentum, but they're going to lose it if these earnings next week don't pan out. So if the market starts sniffing out and saying like, yo, Caterpillar bad now, GE Vernova bad now, Intel bad now, if they start seeing all these large cap momentum stocks start weakening in their earnings and they start running away, it's going to spread. It's going to spread to the other guys because they don't want to hold those either. What's another stock that's going to report tomorrow? Next week? Google. How's Google doing on its weekly? This one's a bit weaker. This one's been going down already into this. And look at that. The MACD is already spreading away. So I could easily see this start widening. So if this thing starts going far away from the signal line into the zero, and then this red DI starts popping up, guess what? That's really going to scare people. This is one of the largest stocks in the S&P 500. Come on now, larger than Intel. What else we got here? McKesson. Let's see, I don't think it's going to have earnings next week though. But it's another example of a momentum stock. Okay, this one lost its momentum back in March. And some of you guys were like saying, well, should you buy it now? Because like, yeah, for long term, I love this stock. If you bought it way back when, in the COVID times, this is great. I just hold it. But for somebody that wants to come in and jump in, where should you jump in? Like if you missed out in September, this was another time that was like, we had some really nasty moves here. You see these two red candles after this earnings, negative 14%. And then looks like there was some bad news. I don't know, dropped another 10% a few weeks after that before recovering into next quarter. But this one, we see just as bad of a down move here. So a lot of red candles from March into May. And now it's recovering right into these moving averages are moving down. So I drew this already, right? I said like, well, maybe it's just going to do this. Well, let's see. We have earnings August 3rd. So it'll take a while. Another 2 weeks. If you bought it at 720, 730, maybe you're willing to wait and see what happens. But if it does break, that's another momentum stock that's going to die. This one is in healthcare, though, I believe. So MACD is already at zero, right? Below zero. This thing already failed. And it's very sloppy. This thing's just very sloppy. The way the MACD is moving, it's not a Caterpillar, right? Caterpillar is so clean. This thing is so clean. Like even with the MACD going below its signal line, it's like you have better faith that it can continue on up. But McKesson, this could be a start of the end, right? It could be, but I don't know. So again, another momentum stock. Let's see what else. What else? Monster energy drink. I like this one too. Another type of momentum stock. This one's not in industrial, right? But it's not a tech company either. But look at that. Very good, very nice. But it also had its share of bad times. So this was like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks going this way. Like it had to wait 1 quarter before it had the other earnings to stop this drawdown. So we had one earnings over here. And then a week later, must have been some kind of news, but it dropped 11%. And then we fell for a little while before recovering the next earnings to go up 12%. So how are we going to deal with this? So this one, yeah, you could see like, let's say this is like a semiconductor stock. It's been moving up, right? And then we hit earnings, and then we have a huge drop into the moving averages like so. Then it took like about 1 quarter before it recovered. So you could have something where it could take another quarter to recover. That could happen. That could happen. So you can see like many examples where, yeah, the trend, if you zoom out, the trend is still good. But you have like moments where you hit a speed bump and it could last a quarter, maybe 2 quarters before you continue the trend up. So we got a lot of these momentum stocks here. We got a lot of these momentum stocks that look kind of like this. How about this one? We talked about this one too. Ross. This is one of the discretionary stocks that look good. Very rare. Discretionary stocks are terrible right now. Like, look at Lululemon. This one's doing good though. But we've hit a speed bump. This one went up from June 2025. You see the MACD here. It looked like maybe we could recover, but I don't know what happened in June 22nd, but this was several weeks after its earnings. Was there some bad news? Was there some bad retail sales data from the government? Because this took it down back to the earnings level, but it's recovered since then. We've been recovering since then. So what do we think now? Do you think this is going to continue its trend or not? That's the question you're asking. So if you look at a stock like this, think of another stock in semiconductors that looks like this. You could think of Texas Instruments. You could think of Intel. You can think of AMD. Right? You can think of Nvidia even. Nvidia has been going sideways since August. Is it ever going to resume its trend? So, yeah, you can hit speed bumps along the way. You can hit speed bumps. We could be entering a moment where we're going to hit a speed bump into November. Very, very shortly. And this is what's going to happen. So I don't know what news happened over here, but maybe it's going to continue its trend. So that's another one. Ross, dress for less. There you are. Here's another one. Let's look at another one. Look at Johnson & Johnson, another one in the momentum stock. Yeah, we got good momentum. This was in June. Same thing with Ross. And then we went sideways. Look at this. Look at this. This one is 2 quarters. 2 quarters worth. We had earnings here. We went up, and then all of a sudden we hit a roadblock. So let's see. Yep. Okay, this one, another earnings here. We went down a bit. We covered. This already reported earnings. This is earnings right here this week, right? Okay, so what's going to happen next week? What do you guys think? You guys think the next week we're going to get buyers and it's going to continue on its merry way up? Or we're going to go deeper? And then we got to fight a little bit before we go on this way up? Or are we just going to do this and then fail and just go down to a lower level and make a larger range over here? And then we have to wait a year before it recovers. What do you guys think? Right? It's not gonna look like a straight line, right? Come on, come on. That's why I love Caterpillar. Caterpillar is a great stock because it looks like this. But not every stock is gonna look pitch perfect like this one. You're gonna have moments where it's just gonna be like, oh, that is painful. That is painful, right? So a lot of stocks have this similar look. They look like they're about to fail. They're about to fail. All right, let's look at another one. Let's look at Texas Instruments. This one could be a new favorite of mine. I don't know yet. This one, we've been going sideways for so long, right? Since COVID. And recently, we've gone up because of the AI stuff. Texas Instruments, usually they make money off of industrial and automotive semiconductors, but they've been trying to get into AI. It looks like it paid off because last quarter, they like the results, and we've been going like this. So, is this the beginning of the trend? We're just at the start of a trend. We could be at the beginning of a trend. Or was this just one quarter? Was this just one special quarter and we're just going to go back and we're going to have to redo this again? And we're just on doing the zigzag on this range. That's what I'm wondering. It's good to be at the beginning. If this is the beginning, this whole range, you could do a point and figure chart and figure out what's the target for Texas Instruments. This thing can go very high, I bet, right? We got from 2021 into 2026. That's a lot of range there to cover, and we could be going a lot higher. All right? Okay, that's all I gotta say. So you see, like, some stocks look like they're at the beginning of the range. Some stocks look like they're at the end of their range. Some stocks, like Caterpillar, are very nice. You know, you kind of go like, well, can a stock look that neat? That's the problem. You ever use the RS indicator that shows stock performance mapped over SPY and SPX? You mean on TradingView? No, I don't know what that is. No. You mean like no, I never use it. Usually I just, if I want to find relative strength, I just do this. Just go like, I'll just take Caterpillar divide by SPY, right? And just get that. Yeah, that's all I would do. Yeah, if I'm doing relative strength, I just go to stock charts or whatever, and then search. I mean, scan for relative strength. That's usually what I do, and then from there, I just find the stocks that I like. So I'm going from stock charts, and then I get everything, a list, and then I don't need to look at it anymore. I'm not gonna look at it like as an indicator on the thing. And stock charts has yeah, I mean, I think you just use it as a scan and you can find everything, so it's okay. All right, anything else? No. Okay, so let's just read the articles. Rabel does it. That's where I saw it. Yeah, I don't know. I don't. He doesn't use TradingView anymore, right? Rabel doesn't even use TradingView anymore. Yeah, he used it for a little while, but I guess he didn't want to pay the subscription anymore. But he doesn't use that anymore. TradingView. So, nah. Okay, that's it. All right. Okay. All right, let's see how much I can get through. Seasonal patterns. Let's see if I want to read this. All right. here. All right, let's go. No, I'm not a robot. Come on. Bloop, 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 bloop. I guess I'll just go to the main website. It doesn't zoom in the pictures. Man, did they make them this small? Come on, guys. Bruh. Man, you guys are weird. How the heck? Why does they? Wow, there's a mini version and a big version. Okay, good. We got this. All right. So this was written in December 29th at the end of the year of 2025. So let's look at the midterm election year patterns. Okay. See how much time I got, because I got to get to some of the. Okay, I got some time. Good. Midterm election year seasonal patterns of U.S. indices. Within the 4-year presidential cycle, the midterm year represents the weakest phase for equities. It is characterized by low single-digit average returns and the cycle's deepest intra-year pullbacks. However, it also sets the stage for the most reliable and profitable recovery rallies, which typically extend well into the following year. Historical data on years ending in 6, dating back to 1806, shows that 85% closed higher and only 4 instances of declines. Her cycles project 9-month troughs for January and October, as illustrated in the charts at the end of this article. The first chart above shows the average seasonal performance of the Dow Jones in blue, S&P 500 in black, the NASDAQ in green, and the Russell 2000 in gray from 1949 to 2024. All follow a consistent trajectory, a period of weakness from January through September, with average cumulative declines of 2 to 8%, followed by a fourth quarter recovery that pushes annual returns toward positive territory. All right, so let's see where we at. We had a good April. That's true. May to June, up to sideways. All right, and like we're in July right now, right? So the NASDAQ, if we follow the green one, looks like we're gonna continue down. The S&P seems flat, neutral into September, before going a little dip, I guess, having a little dip there. The IWM, the Russell's going down. All right. I think Trump kind of messes this up. If you look at the Trump pattern, we're kind of more optimistic than any of these 4 right now. But if we just say okay, if this is a normal midterm election season, then overall we should be going down into October from May. Okay, so May to October we should be going down. So let's see if that's going to be the case. All right, 6 years of president terms, seasonal pattern, the 6 years. So, all right, we're on the 6th year here. Same thing. 6 year of a 10-year cycle seasonal pattern. So on 6 years of 10, I really don't like this 6 year. The whole idea of the year ends in 6, so every year that ends in 6 will have a similar pattern. I don't like that. But if we do follow it, I guess this one matches what we're seeing right now better than any of these. Okay, we went up a lot in April. That's true. Started going sideways going into June. Yeah, that seems to be the case. We got a little drop in July. And then from then on, August into December, we're gonna go up. Yeah, could be. All right. So let's skip these. Okay, blah blah blah. What do we care about here? Midterm elections year seasonal pattern. Okay, we got the 6th. We got the second Republican midterm years, all midterm election years in blue. Okay. So we're going to go sideways from July to August. Could be. Could be. We have a little bump up in August. Okay, that's good. That's good. So second term Republican midterm cycle green begins with a minor January dip followed by a steady ascent that peaks at roughly 6 to 8% by April to June. Yeah, we got that already. After third quarter volatility, where gains typically compress to a 1% floor in September, the market enters a year-end rally exceeding 8% by December. Oh, we got some gold patterns here. Okay, so I mean, maybe we'll follow the. Yeah, the green and red. Maybe that's what we're following right now. But in any case, all of them say October will be the best time to get in. You know, so I'm just waiting for that. All right, let's look at the gold and silver here. Midterm elections cycles. This did not happen like this. Okay, gold did not follow this pattern. Nope, it surely did not follow any of these. But it's let's look at all years. All years says after August we should be going up. So maybe for the first six months of this, it did not follow this at all. But maybe we're going back on track and we'll follow it again in the last 6 months. Maybe that will be like the bottom that we're seeing. So okay, we already went through the cycles, right, that we covered. Okay, let's look at silver. Says the bottom will be sometime in July, and then we should start be going up. Okay, well, let's see. Let's see if that's even the case. It did not follow this pattern completely. We did have a move up into February. All right, I'll give you that. I'll give you that one for silver. But the rest of this, nah, kind of not really. No. No, probably not. Not really. Yeah. I mean, this is better than the gold prediction. That's for sure. Copper. Looks like it's mostly flat, so the copper's not helping us. We got natural gas. We got oil here. All right. Anything else that's useful that we can see? Nothing. So this dude, Jeff Hirsch, his father was the one that did a lot of the Stock Traders Almanac. So every year he makes these predictions based on simple rules like election cycles and decennial, the 10-year pattern. So, and these guys are just like, these guys just do like static patterns though. These guys just do static patterns. They don't try to shift anything around. How valuable this stuff is, well, I'll let you decide. Sometimes it's kind of valuable, sometimes it's not. Like you could see like maybe some of this stuff was kind of true, but not really. No. Yeah. So it has limited value, I think. But this is how people did things in the before. They try to make some kind of cycle stuff here, but it's it's pretty primitive. like look at this. Look at this. I guess this is like a clip. In the 6 years, there is a noticeable tendency to form a saddle. February to March is without exception higher than some subsequent month between May and August inclusive. But also without exception, November is higher than March. Edgar Lawrence Smith, Tides in the Affairs of Men, written in 1939. Yeah, these guys were trying to figure this stuff out long ago. Okay, so and then we got Hearst here, also another cycle dude. Let me see if I can like get a better picture. Look at that. Look at this one. Okay, we got an 18-month cycle projection for the S&P 500. Okay, so look at that. All the cycles say October 3rd is the bottom. So we got 9-month cycle, 20-week cycle. Oh man, these guys go crazy with this stuff. Bro, I never want to do this. So it's great. It's great when you have like the software figure this stuff out for you. Like I just plug it into the software here and go like, okay, can you tell me what the bottom of the Nasdaq is gonna look like? Well, the projection is November 5th. So just a few days after the election, there'll be some kind of bottom. I'm sure the bottom will come like towards Halloween like it usually does. Usually before an election, I always see like Halloween. The Halloween period is when you should start thinking about like getting ready to buy. But it could happen earlier than that, sure. But again, this is Trump, right? It might be a lot different. But as we can see, it's October 3rd. Okay, fine. Let's see if we'll believe you on this one. Okay, so yeah, these guys go crazy. These guys go crazy with this. Let's see. Do I want to read anything here? No. Nope. Man, what is this? Oh my god. Yeah, these guys go crazy. These boomers go crazy with this. Really crazy. Okay, that's one piece I wanted to read for you guys. Done. Okay, let's get to the solar stuff. Alrighty, here we are. Let's start it off with this article here, and I'll continue on tomorrow. Okay, I'm not a robot. I'm not a robot. Come on, I'm not a robot. Once again with this. Okay, let me get this out so it doesn't zoom. Okay. Let's see what this table is. Hey, what's up, roller skate Texas girl? What's up? Okay, let's see. All right, yeah, I got the image. Yeah, I don't think I use that. I don't use any of that. Who got the RSI and he got that like yeah. No. Yeah, I tend not to use that. If I'm gonna do relative strength studies, I go to stock charts and do it there. So I don't try to clutter up anything in the trading view. Yeah, so I try to keep everything light in the trading view. If I'm doing something, I'm just looking at the volume stuff, and then yeah, that's it. I try not to look at too many things. If I'm gonna do relative strength, I'm gonna go somewhere else. Yeah. All right. Okay, solar cycles and inflation-adjusted gold price forecasting. All right, let's read this one. So he's gonna do gold, huh? Okay, Vladimir Belkin's latest study quantifies the relationship between solar activity and the inflation-adjusted price of gold between 1968 to 2025 within a Chevron's Shishevsky analytical framework by synchronizing real gold prices with the ordinal structure of solar cycles measured via sunspot numbers. It identifies a strong and statistically significant fit, um, implying that approximately 90.8% of the variance in real gold prices is explained by his solar cycle model. Okie dokie. Rather than implying direct causation, the results point to a cyclical transmission mechanism in which solar rhythms embed and modulate underlying economic periodicities, notably Kitchen and Juglar type cycles, thereby acting as a structural driver of long term commodity price behavior. Uh huh. The model integrates CPI adjusted gold price data with a superimposed epoch framework, aligning multiple solar cycles into a normalized temporal structure and fitting a sixth degree polynomial to capture the nonlinear progression of price behavior across cycle phases. Okay. See, I told you these guys take this stuff very seriously. This produces a phase-sensitive waveform that preserves both timing and amplitude characteristics of historical gold price movements relative to the solar cycle. The robustness of the fit suggests a stable coupling between solar variability and macro financial conditions, likely mediated through liquidity, inflation expectations, and broader cyclical economic regimes. The study advances beyond descriptive correlation to a deterministic forecasting model. Each calendar year is mapped to its corresponding position within solar cycle 25. So we are currently in solar cycle 25. And forward price projections are derived using empirically observed year to year transition ratios embedded in the cycle structure. Within this framework, 2026 cycle year 7 implies a contraction in real gold prices to approximately $2,536 per ounce, followed by year 2027 to year 8, modest recovery. So wait, hold on. When did you write this? This was written in July 2026. Okay. So this is just a few days ago. This projected path is consistent with the transition from peak solar activity to the declining phase of the cycle, which historically coincides with reduced upside momentum, elevated volatility, or corrective dynamics in real gold prices. For the post 2025 horizon, the model therefore implies a nonlinear, wave structured trajectory rather than a sustained directional trend. Late cycle topping behavior into the solar maximum, followed by cyclical deceleration into late 2020s, the eventual reacceleration as the next solar minimum to maximum sequence unfolds. All right, so yeah, we have a declining solar sunspot activity going into 2030. All right. Let's see. These projections remain conditional on three factors: the accuracy of solar cycle forecast, the stability of the regression relationship, and the interaction with concurrent macroeconomic cycles. Within those constraints, the framework offers a high coherence, quantitatively grounded method for translating solar cycle dynamics directly into forward estimates of inflation gold prices. The extension of Belkin's inflation adjusted gold price forecast through 2032 applies the same chaining methodology using average ratios from column 5 in this table above and starting from $3,623 in 2025. Solar cycle 25 began in 2019 to 2020 and it's expected to end in 2030 to 2031, with cycle 26 beginning. The resulting forecasts are, let's see. So this guy's saying we're going down. We're just going to go down. That's basically what he's saying. Okay. All right. So we won't recover until the new solar cycle in 2030s. The method is unchanged with 2026. Okay. Blah blah blah. All right. Well, let's see. I mean, I'll see. So I got my weekly cycle here, right? I got my weekly cycle here of silver. All right, let's see how silver correlates with this guy. Okay, I'm gonna look at this. I'll look at this. So let's see. Let's see. We have some kind of movement going up into 2028 from 2027. Okay, I guess maybe 2027 was gonna have a good year. So let's see. Well, what does this little chart give me? Uh-huh. Yeah. See, we are gonna go up in 2027. That's true. And then we're gonna move up into 2030 before crashing. What is this? All right, let's see. Uh-huh. Okay. Well, we're going to go down into 2028. Like hold up here. Hold up. Well, that doesn't follow that. All right. 2030, we're going to go down. Oh my god. Okay, yeah, that matches up with this again. Okay. So maybe it is following it. Let me do gold. Let's do gold this one. Let's do gold. Let's see if that's the same. Let's do gold here. This guy spent all that work to do that. All right, let me see with this. I guess we have this cycle. All right, it should be similar, I would think. So no, it's not similar. So this one has a 200 week cycle, and we're gonna go down into 2028 here before continuing up. So 2028 to 2030. Okay, so gold is following a different path, and it's definitely lining up with this dude's forecast. So 2028 is when we get the big push up into 2030. All right, we got that. That's true. And we're going to go down into 2031. Yeah, that's true. Okay. Well, we agree. Okay, I think you get the idea that these boomers are crazy. They really... Oh man, so this guy spent a lot of time with all the math here, and we finally got this chart. Okay, and I think I got my weekly chart here just using the software from the Foundation of the Study of Cycles, and it appears that this and this is in agreement. So if we believe that, then for gold itself, like if I'm really gonna be bullish on gold, I could wait into late 2027 into next year, because from here on out into that point, gold probably isn't going to go anywhere. Like we probably are going to go sideways for a long time. Maybe even going into summer of 2028, it might not do nothing, right? We could just... Dude, that's 2 years away, man. Like I could just be doing something else with my money. So this is the important thing you gotta really realize. It's like, look at this. Gold from COVID went sideways into 2024 before it started moving up. Silver took another year before it even did anything from then, right? Yeah, I could see. Yeah, I could see, like, we probably shouldn't expect a big move anywhere. Like, yeah, maybe silver might have a little pump, gold might have a little pump in between, but it's not a real pump. Like you want something like we saw from 2025 to 2026, like this move here, you're gonna have to wait. You're probably gonna have to wait into 2028. So it's up to you, right? If you think you want to buy the gold now and start buying it into 2027, okay, go for it. But that money could be better spent somewhere else. That's all. That's all I gotta say. Okay, but if it's following some solar cycle, there you go. Now you got a reason why it should follow this. Xian, hey, what's up? What's up, Xian? So there, that's all I gotta say for the gold. Okay, so we went full circle, and now we know why gold is following something like that. Okay, I'm gonna read this article. Let's read this article here. Let's read this one. All right, mysterious 100-year solar cycle may have just restarted, and it could mean decades of dangerous space weather. New research suggests that the unexpected intensity of the ongoing solar maximum may be partly tied to a lesser-known 100-year solar cycle. If true, solar activity could spike further in the coming decades, but some experts are skeptical. When you purchase through links on our website, oh man, that's an ad. Come on. All right. The unexpected surge, okay, of solar activity during the ongoing solar maximum, all right, may be tied to the lesser known 100-year long cycle. If that's true, the next few decades could see further increases in solar activity that may threaten Earth orbiting spacecraft and continue to trigger vibrant auroras across the globe. However, other experts are skeptical of the new findings. Solar activity naturally waxes and wanes through the solar cycle, a roughly 11-year period in which our home star goes from being mostly calm in a phase called solar minimum to being a chaotic mass that frequently spits out powerful solar storms at solar maximum and back again. This cycle is also known as the sunspot cycle because the number of dark patches on the sun rises and falls due to changes in the sun's magnetic field, which completely flips during solar maximum. However, there are several other cycles that dictate solar activity. One example is the Hale cycle, which governs how individual magnetic bands move across the sun's surface and has recently been shown to influence the progression of the sunspot cycle. Historical records also show that the sun has experienced several long-term fluctuations in solar activity over the past few millennia. These included the Maunder minimum, a period of greatly reduced solar activity between 1645 and 1715. Another lesser known repeating pattern is in solar activity is the Centennial Gleisberg cycle, CGC. A variation in the intensity of sunspot cycles that rises and falls every 80 to 100 years, the CGC is still poorly understood, but it is likely tied to subtle sloshing of the magnetic fields in each of the sun's two hemispheres that slightly alters the Hale cycle. Scott McIntosh, a solar physicist at the newly formed space weather solutions company Linker Space, who was not involved in the research, told Live Science. In the new study published March 2nd in the journal Space Weather, researchers suggest that the CGC might have just turned over or started again. This could also explain why the ongoing solar maximum, which officially began in early 2024, has ended up being much harder to predict than initially expected. The study team came to this conclusion after analyzing changes in the proton flux, or number of positively charged particles in Earth's inner radiation belt, the first of two donut-shaped bands of charged particles surrounding our planet. Collectively, these bands are known as Van Allen belts. The inner belt's proton flux decreases when solar activity increases because of interactions with the Earth's upper atmosphere, which swells as it soaks up more solar radiation. On the flip side, the proton flux increases as solar activity decreases. The new analysis shows that flux increased over the past 20 years, but has just started decreasing over the past year or so. This suggests that we have just passed the CGC minimum and that average solar activity will start to rise again, said study lead author Calvin Adams, an undergraduate researcher at JILA, a joint institute of the University of Colorado Boulder and the National Institute of Standards and Technology, told Live Science. The proton flux data was collected by NOAA. Okay, blah, blah, blah. Anything else? We may be nearing the end of the maximum phase of the current cycle, solar cycle 25. Okay, so here, let me show you this graphic. Here we are. This is what we got right here. Okay. So I think these are some predicted values, and then some dude just drew this cyan thing. So the next peak, when we get into solar cycle 26, will be around 2035, 2036. As we move into that area, expect increased global conflicts. Okay, global conflicts will start increasing, and I think I have a tweet. Somebody that I took from somebody else. Let me see if I can find it. I think I have a tweet. I think it's this guy. Here, let me see. Okay, let me see. Let me see if it's this one. All right, yeah. So we had the VIX cycle. Somebody, somebody out there was using the same software to create this VIX cycle. So we're going to have increased market volatility going into 2032, 2033. Okay, so let's say this VIX cycle is an offset of the solar cycle. Okay, so let's see if that's the case. So 2032, 2033. Okay, so we can see like there's a lot of activity in human conflicts that align with the solar maximum. So the next solar maximum will be around like 2035, 2036, right? But, even before we get to the actual peak of the sunspots, there's going to be wars, right, that happen. Like, look at this one. Like, look at Afghanistan and Iraq. I mean, we had 9/11 happen in 2001, right, before we actually hit the peak. Couple years down the line, I would think, is where the actual peak will be. So, and we had the Russian-Ukraine thing happen before we hit our peak in 2025. So there could be some like initial wars, before it becomes a bigger global conflict. I mean, that's how World War I and World War II started. Like, you already had the Japanese and Chinese fighting each other like several years before Hitler started moving around in Europe, right? So, yeah, possible. It's possible that before 2035, we could be having some stuff pop off, right? Maybe a couple years before. So maybe this VIX cycle is just an offset. This 10-year cycle maybe has some alignment with the 11-year solar cycle, and yeah, we could have something happen. In 2031 or 2032. So yeah, watch out for that. There could be something related to it. Now, there was something else called the Brenner cycle that was tweeted in here. I believe I talked about this at least one time before. This farmer created this little chart, okay, based on the cycles he saw. So this is called the Brenner cycle, named after him, Samuel Brenner. So you could go on Wikipedia looking for Samuel Brenner, Brenner, and you can see like it's pretty good. So you would sell your stocks in 1999. That's pretty good, because that was just before the dot-com bubble got popped in 2001. Again, you got 2019. Well, yeah, pretty good. That was just before COVID, so you could have bought back in 2020. And then we have this one, 2035. That's pretty much lines up with the solar cycle, right? If the solar cycle does actually go this, I don't know. This guy could have been goofing off and just drew it in MS Paint, right? He could have been like, oh, maybe it'll look like this. 2035, sure. 2036. So sometime maybe in 2035, 2036, there'll be something really bad that happens. And yeah, that will be the best time to sell your stocks in that. Now, we also have these little cycles here. So B is years of good times and high prices and time to sell stocks and values of all kinds. So 2026 is predicted to be a good time to sell your stocks too. Okay. Before 2035. So yeah, but this could just be like a this could just be the August high, right? Or it could be the high right now. We could be seeing a little temporary high right now before we move on and go up into 2030. That's what I'm guessing. So I'm not sure, though. We'll have to see. Like the other times that we had this predict was like, look at here, 2007, which was a good time to sell before the Great Financial Crisis. And this cycle lines up with 1999 again. 1999 matches up with 1999 up here. So the other time was like 2016. I think 2015, 2016, we went sideways though. So it wasn't like something that was a major deal because of the Asian and European issues, the European debt crisis and Brexit and some other trash. I don't remember. But that wasn't really important to sell then. Let's see, 2034. So that will be the next time to sell. Okay, so yeah, I don't know. Is that should we follow this? So far, this is pretty good. This has been pretty good, but I think something is going on where this is derived from the solar cycles. It's really the sun. I think that's what I'm trying to get at. The sun is really what's driving the world. So. Yeah, I read you one article predicting where to buy gold, and look at that. I think it lines up with this. The next time you would say gold is going to go up is around 2028, okay, into 2029 before we peak out again. And I guess the next time gold is moving up is 2031 into 2033. So it seems that's the way they calculated it with the sun lines up with this, okay? And with this thing here, I think it kind of lines up with the VIX cycles. So something's going to happen in 2030 something, 32, 31. All right, something will pop off then. So yeah, there is some kind of relationship. And at the end of the day, if you want to find out the reason why there's some kind of repeating pattern that shows up all the time, I think you just got to look at the sky and point at the sun and go like, well, it's probably that big thing, that glowing ball in the sky that's messing you up. And it's a big magnetic field, right? It's sending you a lot of radiation, magnetic fields. How do I know that thing isn't a mood, just affects your mood? If they're going to make people more aggressive and go out and protest and fight wars, that yellow ball out there is really doing it. So the Egyptians were right to worship that thing. You guys should just be praying to Ra. There you go. Mengele did Lalo's gynecomastia. What the? Come on, Kyle. Now we ain't gonna bring up that stuff here. All right. Okay. So that's all I wanted to bring up to you guys. Sun. Look at the sun for the answers of how to buy and sell stocks, gold, silver, oil, everything. Everything's related. So you'll find out someday that all you had to do was count how many sunspots were up there. Okay, yeah. Let me read this last one, and then we'll wrap up. I do have some other articles, but I'm not sure how much time do I got left. It's almost 10 right now for me. Can I get to them? See how fast I can read through this stuff. I think the rest of the articles is just repeating what I just said on the other articles. Well, let's go for it. The Centennial Gleisberg cycle. Yeah, see, this. I think this will repeat some stuff, but here you can see the chart, right? So you have like the orange, which tracks the 11-year cycles of sunspots, but then you have something that modulates it, right, on top of that. So you have this longer 100-year cycle that pushes it up and down on average. Okay, so it's just like here when I just add and subtract cycles, that's what's happening. So you have this 192, which is the dominant cycle that I see here. But I could add more cycles. I could see there's a bunch of other ones. I don't know how much they would influence things. Let's add this 73. So see, I can modulate it. I could add another cycle like this one on top of that 192. I could do that. So that's what it's doing. That's all it's doing with this. So for the past 15 years, the sun has been near a low point in its cycle, but this is about to change. So we got this whole thing about the cycles that are changing here. Yeah, I think this is just the same repeating stuff that we read in the previous one. So what they're using, we have been looking at protons in the South Atlantic anomaly, explains the paper's lead author. So yeah, I think I read some of that already. It turns out that the protons in the South Atlantic anomaly are a canary in the coal mine for the Gleisberg cycle. When these protons decrease, it means the Gleisberg cycle is about to surge. That's exactly what we found. The protons are clearly decreasing in measurements we obtained from NOAA's Polar Operational Environmental Satellites. Okay, blah, 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 blah. The resurgence of the Gleisberg cycle makes a clear prediction for the future. Solar cycles 26 through 28 should be progressively intense. Solar cycle 26 peaking in 2036 would be stronger than the current solar cycle 25 and so on. The projected maximum of the Gleisberg cycle is around 2055. Oh man, so 30 years, another 30 years of hell, I guess. So the past 30 years we've been having very good times, right? It was easy in the stock market. Who knows? Maybe the next 30 years it's just gonna be harder to just go up in a straight line. We've been going up in a straight line, up to an exponential line so far, but I guess the next 30 years is gonna be worse. On average, with a major increase in launch rates, it'll be important to plan for changes to the space environment that thousands of satellites and spacecraft are flying through from all sides. Solar activity and particle fluxes could all be very different in the decades ahead. Maybe that's why they're in a rush to go to space. Well, that's if you believe in space and you believe that the Earth isn't flat. Okay, so I can't help you if you otherwise. So you should ignore what I'm saying. All right, so we're done with that. Good. Anything else in this article we were reading? Nope. No. I don't think. I don't think that we need to go into details anymore on this article. Okay, good. Okay, another 2 articles. Let's get to this 2 and then can wrap it up with the final one. All right. Some McClellan articles here. Are traders really just driven by the sun? Okay, so this is a solar radial flux. And we got the Dow Jones on blue. This was written in 2011. As you head off into a long holiday weekend, and I hope yours is a joyous one, so this was written in December, I thought I would give you something a little bit more fanciful to chew on. This week's chart shows an interesting correlation, or perhaps I should say that it is a troubling correlation. We have all been told by the financial media that the wild up and down movements of the stock market this year stemmed from investors' reactions to the various plans and announcements coming out of Europe, focusing on its debt problems. But here we are seeing that the ups and downs of the Dow Jones seem to match the rise and fall of solar radial flux. All right, let's see the solar patterns here. All right, okay, I guess they kind of correlate. Flux is a measure of the energy output of the sun and is an excellent indicator of overall solar activity levels. It is associated with the 11-year sunspot cycle, but it varies a whole lot on a daily basis, as the chart illustrates. So, why could it be that rising solar flux would lead to rising stock prices and vice versa? That is the deep and possibly troubling question. Some people have theorized that the fluctuations in the amounts of charged particles hitting the wiring in our brains can affect collective moods, just as they can affect electrical power grids and microcircuitry. That's as good of an explanation as any. I usually operate on the philosophy that if the correlation is good enough, no explanation of the root cause is necessary. Here is something more to chew on. Perhaps it is not the radial flux that is really doing the job of affecting our brain's wiring, but rather the spikes in solar flares that seem to arise out of the low points in radial flux. This next chart looks at the count of S-class solar flares. All right, here we are. Let's see. I got some peaks here. So that's what? Is that the peaks of the stock market? This one didn't work. This one didn't work, did it? No, I don't think so. Okay, you can see that the biggest spikes in the numbers of these flares tend to coincide with meaningful bottoms for stock prices. Kinda. Yeah, I guess. These spikes also happen to arrive at minimum points for the total radial flux, as if the surge in solar flares kicks off the next rising phase for that measure of solar activity. The Dow Jones rise up out of the minor price bottoms on December 19th in 2011 coincided with an upward surge in the number of these S-class flares. Other spikes in flares in 2011 have also coincided with important lows, although not all price lows have flare spikes to explain them. One trouble with identifying this relationship is that it is not much good for those of us in the forecasting business. The relationship between solar activity and stock price activity seems to be a coincident one. We know that it is related to the 11-year sunspot cycle, but even that cycle can vary from 9 to 14 years. Forecasting solar weather on a daily basis has proven to be very difficult. You can access the historical data on NOAA's website and play with the numbers yourself. If you are curious enough to delve into this, you can also get daily updates from www.spaceweather.com. I am certain that a lot of readers will have trouble accepting the idea that stock prices could in any way be driven by changes in solar activity. I have some trouble accepting it myself, but every once in a while it can be worthwhile to take a look at a wild idea just to see if there is any merit to it. The evidence here seems to be strong enough to demonstrate that there is something going on there, even if it's not good enough to figure out how to make money off of it. One possibility is that if you see a big solar flare that is bigger enough than what has been happening around that time, then it is an invitation to a stock price rally in the days to follow. But putting that effect into quantifiable terms and actionable information is more elusive. Well, maybe we gotta figure that out, huh, guys? I've heard there's an 11-year cycle of the sun. Yep. Well, yes, we already covered that enough times here. Let's read another article. How about this one? Let's go with this one. And it looks like it can vary between 9 and 14 years, which is quite broad. So, Predicting these sunspots and cycles and solar flares and fluxes. Well, is there a cycle within those cycles then that we should be looking at? Maybe that's how we should do it. Sunspots and the stock market, a weak relationship. So here we are. I have asked recently, so this is written in 2018, about the upcoming grand solar minimum and whether it means anything for the stock market. This is something I have looked at, and the answer is that I wish it was more meaningful than it really is. Solar minimum is when the sunspot count becomes bottoms out as the sun goes quieter. The sunspot cycle averages 11 years, but over the historical period, its period varied between 9 and 14. This week's chart shows that at solar minimum, there is often a noticeable bottom for stock prices as long as you allow a punctuality tolerance of about 2 years. Well, that sucks. That's not very good. That is a pretty wide window for market timing purposes. So while it is an interesting phenomenon, it is not that useful for trading decisions. And not all solar minima see the same degree of an effect. The solar minimum did coincide with really important bottoms in 2009 and 1974 and 1932, but at other times, like in 1994, it is tough to find the stock market bottom, which marks the solar minimum. There does not appear to be any great bear market effect going on right now. It is also interesting that the midpoint of the solar cycle usually sees some kind of meaningful price bottom, roughly in line with the peak month for solar activity. That's fascinating, but again, not that useful, because we don't know while it is happening that one particular month is going to mark the peak of any given cycle. So I chalk this up in the category of fascinating but not very useful for investing or trading purposes. With that point established, I will go on to say that the sunspot cycle can be shown to matter more reliably in other human social events outside the stock market. The ascending phase of a new solar cycle, which is still a few years away, typically sees one or more mass public protest events. This is a thesis first put forth by Russian researcher Alexander Leonovich Zhizhevsky, who correlated instances of wars, revolutions, riots, etc., with the sunspot cycle going back over 2,000 years. He wound up spending a long time in a Russian gulag because of his views about what sparked the 1917 Russian Revolution, conflicted with those of Joseph Stalin. The next two charts show the monthly sunspot number, and the 9 to 14 year cycle period is fairly evident. Typically, we see the major protest movements on the ascending phase of each cycle, and the Arab Spring in 2011 was a great example. All right, you can take a screenshot of this right here. Another screenshot right here. This is not to say that there are not protests at other times in the sunspot cycle. But the point is that protests arising at other times do not typically arouse the same degree of mass support from the public. The increasing solar activity seems to work somehow on human brains, increasing our collective uppityness, such that long festering problems finally come to a head, and people are willing to go out into the streets to try to do something about them. Those protests and the public's annoyance about them may have existed for a long time before, but something about having Earth receive an increasing amount of charged particles from the sun in ascending phase seems to spark that annoyance into action. The last solar minimum was in 2009, and so counting forward 11 years, we get to 2020 as the ideal time for the next solar minimum. Oh man. All right. Well. Well, 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 well. Well, 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 well. Oh yeah, 2020. What a great time 2020 will be. Yeah, it was a great time, wasn't it? So there you go. Um, you know, I think you can predict the future if you start studying this stuff. But remember that it can vary from 9 to 14 years. When we get to the next ascending phase, a couple of years after the next solar minimum, we can look forward to some big public protest movement being a big deal, perhaps in the United States, perhaps elsewhere. What that grievance will be about to is not something I have the ability to forecast, but I can say that if President Trump is successful at winning re-election in 2020, then dealing with that protest movement in the early 2020s will be the main theme of that second term. And if someone else defeats President Trump in 2020, then the appearance of a mass protest movement in 2022 to 2024 could perhaps doom that president to only a single term. So, do you wonder if people did COVID-19 to lock people up so that they couldn't protest in a bigger way? I mean, we did have the summer of love in 2020, but let's say we didn't have COVID-19 lockdowns and you let people be freely go out, moving about normally. Do you think 2020 would have been a great revolution? And the elites knew that the sun was going to do something at that time, and they said, yay, why don't we just lock people up because of a virus so that they can't be outside and we can control their protesting? So we allow them to protest, but in a controlled manner. Makes you think, huh? It makes you really think. Anyhow, that's all I wanted to say about that. Let's see what else we got here. One last article to tie it all up, and we'll be done for the night. So we already played this video before. So this is a summary of what I've shown you. Okay, so let's see if I got time. I don't think I need to read this. We already played this video, Sunspots and Markets with Tom McClellan. Okay, this was back in March. And I just wanted to show this picture here. Okay. McClellan's central observation involves the spread between 10-year and 1-year U.S. Treasury notes yields, a standard measure of the yield curve steepness. When this spread is high, long-term rates far exceed short-term rates, typically reflecting a period when the Federal Reserve has cut rates in response to economic weakness. When the spread inverts, goes to zero, short-term rates exceed long-term rates, usually because the Fed is tightening to combat inflation. What makes the analysis remarkable is the overlay. When you shift the sunspot count forward by approximately 3 years and plot it against the yield spread, the two series track each other with surprising fidelity. Sunspot peaks lagged by 3 years correspond to peaks in the yield spread. Sunspot troughs correspond to yield spread troughs. So these are like the exceptions, right? COVID over here, and the Great Financial Crisis, QE, over there. But for the most part, we follow this. So where are we at right now? We're in 2026. So we should have a long-term higher rate. And that means, okay, that means we won't have a problem. Okay, we won't have a problem, I think. Yeah, I think. Is that it? We won't have a problem? Let's see. Let me read this. Long-term rates far exceed the short-term rate, reflecting a period where the Federal Reserve has cut rates in response to economic... okay, wait a minute. Okay. So we will have some problem, maybe 2027? Okay, so, all right. So we should be watching out for 2027 then. All right. So we're rising into 2026. That's where we're at right now. So probably something is going to happen 2027. That's what we're going to look at. So, all right. That's what we should be predicting here based off of this. There's going to be a problem at that time. Let's see. What else? Anything else? No. Yeah, that's interesting. That's interesting. That, yeah, there are two exceptions right now that we see. So, yeah, this doesn't work all the time. Yeah, these exceptions. So this steepening trend should continue toward a peak around 2027, roughly 3 years after the 2024 sunspot maximum. So right now, yeah, we are having a yield curve, a steepening. When the spread is high, long-term rates of far exceed short-term rates. So yeah, maybe something will happen 2027, maybe 2028. So that's what we'll probably be looking at. All right. So that's all. That's all I wanted to highlight for you. So take a screenshot of that. All right. I'll see you tomorrow. I think hopefully we could cover enough stuff. So I didn't get to do 2 streams today. Maybe I'll try again tomorrow. Try to do 2 streams. Gotta get through some AI stuff, and then we have to do some DeMark studies. All right. We got to get through some DeMark studies. There's a lot of stocks to look at to see, prepare for the earnings season that's about to get even wilder. We only had a few stocks report earnings that were important. There are going to be more in the coming 2 weeks, 3 weeks. So